It begins with speculation. Economists, investors, and technologists debate the possibility of a cryptocurrency overtaking traditional fiat currencies. Bitcoin, with its decentralized ledger, finite supply, and borderless nature, emerges as a serious contender. Governments and institutions issue warnings, yet adoption grows, fueled by public distrust of traditional banking, geopolitical uncertainty, and the allure of financial autonomy. Eventually, legislation, societal pressure, and technological innovation converge, and Bitcoin officially replaces the US dollar as the national currency. The first consequence is monetary chaos. The Federal Reserve, accustomed to controlling money supply, interest rates, and inflation, loses its primary tool, the ability to issue currency. Inflation targeting mechanisms, quantitative easing, and lending policies become ineffective. Economic forecasting becomes extraordinarily difficult as the economy adjusts to a fixed supply, decentralized currency system. Governments worldwide observe with concern as the U.S. abandons fiat monetary sovereignty. Financial markets react violently. Stock exchanges face unprecedented volatility as investors adjust valuations to a currency whose value is inherently volatile. Companies reliant on predictable cash flow and interest rates struggle to plan budgets, pay debts, and manage operational expenses. Institutional investors face challenges in asset allocation as traditional hedging strategies are rendered less effective. ETFs, mutual funds, and retirement portfolios experience extreme fluctuations in value. Banking systems are destabilized. Deposits, loans, and credit are now denominated in Bitcoin. Banks, which traditionally rely on fractional reserve systems, face liquidity challenges as digital currency flows bypass traditional institutions. Lending practices are disrupted, interest rates become highly speculative, and credit availability shrinks. The collapse of conventional banking mechanisms causes panic among both consumers and corporations. Consumers are immediately affected. Salaries, savings, and pensions, now denominated in Bitcoin, fluctuate dramatically in value. Businesses struggle to price goods and services effectively. Purchasing power becomes unpredictable, leading to reduced consumer spending, hoarding behaviors, and general economic insecurity. Households face difficulty in financial planning, creating widespread uncertainty. Corporate operations are deeply impacted. Companies with existing debt in US dollars experience massive valuation swings as debts are converted to Bitcoin. Loan servicing, contract fulfillment, and supply chain payments are disrupted. International contracts, often denominated in stable fiat currencies, require renegotiation. Businesses face operational paralysis as accounting, taxation, and payroll systems adapt to a digital currency with high volatility. Government revenue and fiscal policy face unprecedented stress. Tax collection, budget planning, and public service funding are severely affected. Corporate taxes, payroll taxes, and income taxes become difficult to administer accurately in a decentralized, volatile currency system. State and federal budgets require emergency restructuring. Social programs, infrastructure projects, and defense spending are jeopardized. Congress and the Treasury scramble to adapt fiscal policy to a radically altered financial landscape. The stock market experiences extreme volatility. Publicly traded companies, particularly those with high debt or international exposure, see stock prices swing wildly based on Bitcoin price fluctuations. Market indices plummet and recover unpredictably, reflecting underlying economic instability. Investor confidence is shattered, and portfolio management becomes increasingly speculative. Long-term investments are deprioritized as market participants focus on survival and short-term hedging. Inflation and deflation occur unpredictably. Bitcoin's fixed supply creates deflationary pressure in certain economic sectors, while market demand and volatility produce temporary inflation spikes. Consumer goods, housing, and commodities fluctuate in price rapidly. Businesses struggle to set stable prices, and long-term contracts face constant revision. Economic inequality increases as individuals with early Bitcoin holdings gain wealth, while those without liquidity face financial collapse. International trade is restructured. Countries conducting trade with the U.S. must adjust to Bitcoin-denominated transactions. Exchange rate uncertainty, regulatory differences, and cryptocurrency volatility complicate cross-border commerce. Global supply chains face logistical and financial disruption, with businesses adjusting pricing, payment mechanisms, and contractual obligations. Nations with weaker cryptocurrency infrastructure struggle to maintain economic stability. Commodity markets are affected significantly. Oil, gas, metals, and agricultural commodities experience extreme price fluctuations as Bitcoin replaces fiat pricing standards. Traders face higher risk premiums due to currency volatility. Futures markets, options contracts, and hedging strategies are recalibrated to accommodate a decentralized, non-sovereign currency. Volatility spreads to all commodity-linked financial instruments. Employment markets experience structural disruption. Payroll conversion to Bitcoin introduces uncertainty in wages and benefits. Gig economy workers, freelancers, and salaried employees experience irregular purchasing power. Workforce planning becomes difficult as corporations struggle to estimate operational costs, employee compensation, and productivity. Strikes, labor disputes, and mass renegotiations are common. Bankruptcy rates increase. Businesses unable to adapt to a Bitcoin-denominated economy default on loans, fail to pay employees, or unable to meet contractual obligations. Small and medium-sized enterprises are disproportionately affected, while large multinational corporations face operational and financial strain. Legal systems are overwhelmed by disputes over contracts, debts, and obligations tied to fluctuating cryptocurrency values. The real estate market is destabilized. Property transactions, mortgages, and rental agreements shift to Bitcoin. Homeowners and investors experience rapid valuation changes, creating uncertainty in lending and purchasing. Commercial real estate suffers as businesses struggle with fluctuating operational costs and uncertain revenue streams. Housing affordability and accessibility become unpredictable, affecting urban and suburban communities alike. Public perception of wealth and financial security is altered. Early adopters of Bitcoin gain massive wealth, while average citizens experience volatility-driven losses. Social stratification increases, fueling unrest, political pressure, and calls for regulatory intervention. Consumer confidence declines, impacting retail, entertainment, travel, and service industries. The economy contracts as individuals prioritize financial preservation over discretionary spending. Government debt and national bonds are transformed. The U.S. Treasury, previously issuing dollar-denominated debt, faces recalibration to Bitcoin terms. Bond yields, interest obligations, and investor confidence fluctuate in response to cryptocurrency volatility. Fiscal stability becomes challenging, and international debt relationships are strained as foreign governments recalibrate exposure to a Bitcoin-denominated U.S. economy. Banking regulation becomes urgent yet difficult. Anti-money laundering, taxation, fraud prevention, and consumer protection require new frameworks compatible with cryptocurrency systems. Federal regulators, accustomed to centralized oversight, struggle to enforce compliance. Financial crime, digital theft, and systemic fraud increase, creating further instability in economic and political institutions. Consumer behavior evolves. Individuals adopt decentralized finance platforms, digital wallets, and peer-to-peer transaction systems. Traditional banking reliance decreases while risk exposure increases. E-commerce, remittances, and financial technology expand rapidly, yet disparities in technological access create inequality. Certain demographics are left behind, exacerbating social tension. Global financial markets are affected. Foreign investors, multinational corporations, and commodity traders adjust portfolios to hedge against Bitcoin volatility. U.S. dollar-denominated assets lose dominance, and alternative reserve currencies gain influence. International economic alliances and trade agreements are renegotiated. Emerging markets face challenges integrating with Bitcoin-based trade flows. Corporate accounting and auditing are transformed. Companies must adopt real-time cryptocurrency valuation systems, monitor blockchain transactions, and adjust financial reporting. Auditing standards evolve to account for asset volatility and decentralized ledger structures. Failure to adapt results in regulatory penalties, investor distrust, and operational inefficiency. The technology sector experiences rapid expansion. Blockchain infrastructure, cybersecurity, digital wallets, and decentralized finance platforms see unprecedented investment. Corporations, government agencies, and individuals invest heavily in secure Bitcoin management. Yet technological disparity creates systemic risk, as inadequate adoption or cybersecurity failures can trigger financial collapse. Consumer finance evolves toward decentralized lending and credit. Peer-to-peer loans, smart contracts, and decentralized finance platforms replace traditional banking services. Credit availability is tied to cryptocurrency holdings and blockchain reputation. Interest rates fluctuate with Bitcoin price swings, creating uncertainty in borrowing and repayment. Financial literacy becomes essential for survival in everyday economic life. Stock market recovery depends on Bitcoin stability. Until volatility is controlled, investor confidence remains low. Corporate valuation models are adapted to cryptocurrency reality. Companies prioritize liquidity, risk management, and operational flexibility over growth. Mergers, acquisitions, and capital investments slow as financial systems adapt. Government policy evolves under pressure. Taxation, welfare, and regulatory frameworks are rewritten for a decentralized currency. Social programs, defense spending, and infrastructure projects are recalculated in Bitcoin terms. Policymakers grapple with balancing financial sovereignty with economic stability, as inflationary or deflationary pressures create unpredictable societal impacts. The energy sector is affected indirectly. Mining operations for Bitcoin require substantial electricity, creating new demand pressures. Energy costs rise, infrastructure strain increases, and environmental concerns intensify. The balance between economic necessity and sustainability becomes a political and financial dilemma. Global economic influence of the U.S. is challenged. Dollar hegemony collapses, international trade flows adapt, and geopolitical leverage shifts toward nations with alternative currency reserves or cryptocurrency infrastructure. U.S. policy, diplomacy, and trade agreements are recalibrated to accommodate a Bitcoin-based economy. Social inequality intensifies. Wealth distribution is influenced by prior cryptocurrency ownership. Those without Bitcoin savings face reduced purchasing power, limited access to credit, and diminished economic mobility. Social unrest, political pressure, and public distrust increase, creating societal instability that further affects economic growth and corporate confidence. Corporate risk management evolves rapidly. Companies hedge Bitcoin exposure, invest in digital asset security, and diversify revenue streams. Supply chain agreements, international contracts, and financial planning are renegotiated to reduce exposure to cryptocurrency volatility. Failure to adapt results in corporate failure, bankruptcy, or market exit. The future of economic planning is redefined. Traditional fiscal and monetary models become largely obsolete. Governments, corporations, and individuals must adopt cryptocurrency-based economic strategies. Planning horizons shorten, contingency measures expand, and adaptive flexibility becomes a key determinant of survival. Ultimately, replacing the U.S. dollar with Bitcoin is a transformative, chaotic scenario. Monetary policy collapses, banking systems are destabilized, stock markets fluctuate wildly, corporations struggle to operate, consumer behavior shifts, and global trade patterns are redefined. Recovery, adaptation, and stabilization require decades of structural reform, technological investment, and social adjustment. The story of a Bitcoin-dominated U.S. economy demonstrates both the potential and peril of decentralized currency. It illustrates the fragility of traditional financial systems, the volatility of new monetary frameworks, and the profound ripple effects that such a fundamental change would produce across Wall Street, Main Street, and the global economy.